Hi, everyone, and welcome to AB Conversations, where we will help you CFP your way out of it. A podcast where you get into the minds of a couple certified financial planners on how we think and feel about everyday financial planning questions and what should really matter most to you. A healthier financial life starts now. And we're back. Hi, Adam. How are you today?
Fantastic. How are you?
I'm good. I am good. We are officially in July. Crazy to believe that we are just speeding through the summer here.
Yeah.
So you and I thought it would actually be a good opportunity to kind of take a little pause from all the financial planning conversations we've had and remember that investments are really important too.
Mm-hmm.
And for as much as we were so laser focused on everything that was happening in 2020 with investments, it's kind of felt like an uneventful year when it comes to investments thus far, but that doesn't mean there aren't things to talk about. So let's call this our, mid-year investment review. What do you think?
Yeah, that sounds great. So let's start with the review part. So okay. I think as you alluded to, right, there's certainly been headline news. There always is. It's always catching attention. We're always having conversations around the investments and, should we be doing this? Should we be doing that instead? But yeah, since we've gotten on the other side of the election as kind of the big mile marker for volatility, or at least expected volatility, the stock market in particular, has been fairly quiet and tame for these first 6 months overall.
Yeah, I've often kind of framed that in the sense of market pullbacks. We define as like 5% coming down from a high point. We haven't had one this year. We actually haven't had one since the election, which is the longest period of time we've gone without having one of those since the end of 2017 going into 2018. So yeah, just from a historical context, we had 5% pullbacks last year. A lot of them occurred after the bottom of the market. And again, it's all relative at that point. It didn't really feel that volatile after falling off a cliff in March. But to your point, there hasn't been a lot of movement back and forth, kind of seesaw effect like we typically see in a given year.
Yeah. So even acknowledging that, in just looking at performance, right? How have stocks and bonds actually done up to this point? Now we're at the midway point. There are still pockets where even within just stocks in general, right? Not everything is created equal. We've certainly seen that. I feel like we talked about that in a recent investment focused podcast, that the difference between a large stock and a small company stock at this point, there are still wide divergences between what they're actually returning. You throw in international in there as well. There's just a lot of moving pieces that you see the headline news again. It's the S&P 500, the Dow. We've seen the NASDAQ. We seem to be hitting all-time highs with regularity here lately. Yeah. Mm-hmm. But under the surface, again, not everything is necessarily at that all-time high. So even just pulling back the curtain a little bit, the difference between large growth and large value, which the idea behind once the vaccine was kind of announced and approved back the end of last year,
November.
Value kind of took over the leadership from growth. So when COVID happened, large cap growth companies just continued to soar, right? That's your Amazons, your Apples, your technology-based companies. And since the vaccine, that has kind of ebbed and now switched to value, right? Your financials, your utilities, kind of the things that didn't quite do so well in a COVID-induced shutdown. But now, even saying that, these last couple of months, that has equalized again to value is still slightly ahead, but it's much more evenly split, I think, than anyone would have expected at this point, thinking that we're in a pretty early part of this recovery.
Yeah, and I guess that's the hard part to wrap my head around, because we do think like recovery, everyone's talking about the economy reopening, people are going to be busy for the summer. A lot of the headlines we still see is now it's not unemployment is a problem. There are 9 million jobs that aren't being filled. people are quitting jobs either because of stress, not enough pay, childcare, any number of reasons. So there are going to be these hurdles, I think, within the economy and kind of getting that recovered. But if we add the perspective of, but how have investments done through all this turmoil? The S&P was up close to 30% in 2019. It was more than 16% last year. We're hovering right around, 14, 15% year to date. It seems crazy. It seems crazy that we've had all that return in the broad market, and we're still trying to like move ourselves forward economically. But I guess that's why even certain headlines here and there, whether it's unemployment, whether it's inflation, even certain things that don't feel great, cyber attacks, and is there another strain of COVID? These are things that aren't disrupting the market because there probably still is so much economic recovery to come.
Yes, that's absolutely the case.
Okay, I think we're done here. I guess the point being, when it comes to kind of looking backwards, there have been these headline things, but we really do see, to your point, volatility's been pretty low. Growth in the market has started to feel more widespread, not just pockets. And we're not reading a lot of things that would give us pause for the second half of the year.
Yeah, I had this conversation 2 days ago that we had a client ask the question, and now I'm switching gears a little bit, but client asked the question of, if headline news right now, to your point, we haven't really had a lot to talk about other than kind of inflation is kind of the biggest one. And I know we just did a podcast on this recently, but his point was, well, if inflation we think is going to become a problem, interest rates are extremely low, why are we still continuing to hold bonds in my portfolio? Should I not just start to divert towards stocks if you think stocks are going to do okay? And while fundamentally, right, that thought may not be flawed, we as fundamental investors take the approach that we're going to stick to diversification, right? Even though the bonds themselves may not be adding to your return potential, they still have a critical role in your portfolio to be the ballast, to be the safety net, that if at any point something comes out of left field, that you're not now overweight or taking on way more stock market risk than you could stomach. Because again, I think we've seen this before, right? When times feel good, and you made the point, right? The last 3 years worth of returns now have been double digits plus. It feels very easy to just say, hey, I'm just going to go buy some stocks and they're going to go up 15% in any given year. Yes, that has happened the last 2.5 years, but will that happen the next 2.5? Maybe. I don't know. Nobody knows, is I guess the point. So we're going to continue to remain diversified. We may skew here or there, and we've had that conversation too, right? Tweaks that we make are minor, as opposed to let's just change our risk profile on a wholesale level.
It's such a good conversation because I think you and I and our team talks about this more frequently than our clients probably understand that we do. Because while we're not making a lot of changes, it's a very conscious decision not to make those changes. And part of that is just having to stick to your guns. We are running hot, right? And I think we've talked about this in other ways. You have to start with a target allocation, and we build that off a financial plan. We did build that off of risk return parameters that are appropriate, not only for that plan, but for how people feel about risk. So if we're targeting 60% in equities, right now those allocations they're pushing 65, 66, even 67. So it is a conscious choice to say we're definitely overweighting stocks right now. But yeah, we can't be the team that goes, well, let's just forget about bonds. We know we're not going to make a lot of money there, so whatever, everything in stocks, because you know how that goes. That'll be the day. I liken that. I liken that to, I just read this morning, and I know we did a conversation about the fear of missing out before, not too long ago. Certain cryptocurrencies that became very popular in headlines. As one example, if you were to buy something that starts with bit and ends with coin on April 1st, thinking, oh my gosh, this is the next craze. Look how much money it made in the first quarter, like 100% return. It was down 40% in the second quarter, right? So I think these bandwagon jumps from one thing to the other, it's a very dangerous thing. I get it. It's a recency bias. The stock returns have been so great. But even though we've seen really strong stock market returns, and we really believe that is going to continue, to leave bonds for most people, just wholesale leave bonds, it's not appropriate.
Yeah, I agree, obviously.
Yeah. So another thing I did want to talk about, the volatility index. I think if we're going to make comments like, hey, we don't see certain bad things coming in the economy, and we're not here to kind of predict what happens next, but I think certain people, and that we advise, and maybe on different podcasts, we've talked about the volatility index. So indulge me for a moment. There is a way the market does try to gauge what is perceived volatility in the future going to be. And the way that it does that, if you and I are going to place a bet on something, we kind of have to know what we're at risk of losing. And the options market, not going to get into those details, but it's a way of trying to gauge, how much risk is associated with this one stock if I am going to either buy it or have the option to buy it in the future. So long story short, when those option prices are much higher, it's because there's perceived to be more risk in the future. The volatility index is at 15 today, or in that range. 18 is historical norm. It was 37 back in January. It was in the 80s last March, right? So it's not to say that things can't change tomorrow, but it's certainly, if the options market is a way of kind of projecting where volatility is going to go, we're not only at historical numbers, we're actually below it.
Yeah, which I mean, yeah. I obviously I follow that. It's something I look at, but I am absolutely guilty of kind of the recency bias, and you sharing that, even back in January, it was still in the 30s. Just again, like the last 3 months are in my head of just seeing the number just slowly start to come down. And I've seen it, below 20 here recently, and hearing that it was in the 30s again in January, it didn't feel like that at the time. And I guess that's the other thing to think about too. Just because that volatility index may show a higher or a lower number doesn't necessarily translate to the day-to-day, market movements. But yeah, it certainly hasn't felt like we've had higher numbers in that volatility index even at any part this year.
Yeah, and if we just kind of relate that back to the uncertainty of last year, right? When we were talking about investments, it felt like every day with our clients, right? It's almost like we had to pivot from being financial planners on a daily basis to, hey, psychologically, what's going on? How are you thinking? How are you feeling? Stay the course, stay the course, stay the course.
Yeah.
These are big picture things. When is the economy going to reopen? Is there going to be a vaccine? What's going to happen with an election? What does that mean for policy? There were many things that felt like it was going to move the market. And what do we have right now? Inflation, I guess, a little bit. Our cyber attacks on energy companies and meat companies going to be more of a regular thing. It's not to belittle it, but these do feel like little ripples coming from like a little stone thrown, and not some sort of tsunami like it felt like last year. So it's just, there's not a lot right now that I think should lead people into feeling panicked in any way, shape, or form. And we'll stick to the plan. Yeah.
So then on that front, we'll kind of talk about outlook moving forward. Kind of talked about how we've gotten to where we've gotten to this point, right? Returns have been good for the stock market. For the bond market, returns have not been so great this year, and I feel like we've talked about that recently too, right? It's interest rates are still, the Federal Reserve is still extremely accommodative, right? Their policies are meant to stimulate the economy and also support riskier assets such as the stock market. So that low interest rate environment hurts conservative savers, right? You're not earning anything at the bank in a savings account or a CD.
Right.
Bonds are their yields are coming down, right? So just owning a bond, you're getting paid less and less over time here as interest rates stay essentially near zero. And now the looming threat of inflation, whether it comes to fruition and sticks around or not, is kind of neither here nor there for the here and now of owning a bond fund. Essentially, the 10-year treasury, you went out and bought a 10-year treasury right now, and it's yielding 1.5%. If inflation is around 2%, you're actually losing that 0.5% in any given year, right? You're safely losing your money by having it in a safe position. So it's all part of the Federal Reserve's job to try to stimulate growth, right? Get the economy back and running, and have the stock market kind of be the recipient of a lot of those flows of dollars. So from that standpoint, looking forward, that has tempered a little bit. But I think back to your original point, right? We believe in diversification. We're not going to abandon bonds. It's just that the outlook right now is not, they're not going to be an adder to your return base. But then what does that actually mean for us moving forward? And I think it is just sticking to a diversified investment portfolio, right? You said it, based off of your situation, right? What does the financial plan tell us how you should be invested? How do you feel about risk in general? And let's stick to that plan.
Yeah, and so I call that just resetting expectations, right? And maybe some of that is the fact that if we really wrote a plan that we were going to stick to in 2017, saying, hey, if we can get on average a 5-6% rate of return, you've probably done way better than that.
Right.
But if that does mean then that maybe you're borrowing some of those returns from the future, if at some point here the stock market is going to level out and interest rates are going to be where they're at, these expectations of double digits returns are not going to run forever. So I think it just does come back to stay within your lane. What does the plan say? Trust us to make some tweaks on your behalf to make sure that we are managing these things effectively if there are going to be little things that need to move. But yeah, mid-year review, we're not looking to do anything drastically different here.
Yeah, exactly.
Yeah, and I think the headlines probably will continue to be focused on economically, are things really recovering? Maybe it's more of a focus on individual company earnings and quality companies. There's still going to be policy conversations. I think that's going to happen. Dropping my earpiece here. But even that, we've seen, the headline is a $4 trillion infrastructure bill that gets negotiated to like $1 million. Policy ideas do not always come to fruition. And I think as we get deeper into the year, moving into what will be another mid-year election year next year, you kind of see people jockeying and political parties jockeying for, another round of elections. So who knows how much negotiating goes on the beginning to middle part of next year. Who knows?
Yeah, exactly. So the other part of that in my head is, the old saying, a rising tide lifts all boats, is that, the flipping a switch of turning off the economy, back in March of 2020, somewhat reset the business cycle, even though it was unlike anything we've ever experienced before. So here we are, how many months? 15, 16 months now removed from kind of that initial shock to the system. And even just talking about stock market returns being essentially almost doubled from the market lows at the end of March of 2020. Here we are in the S&P 500, almost up 100% from the bottom. It's kind of hard to fathom. But my point is, it seems like kind of those, once it seemed like we were able to weather that storm and get to the other side, those easy returns, right, where you could pretty much just pick any stock at the end of March of 2020, and it's probably been really good these last 16 months. That period seems to be waning, where now fundamentals should start to matter again to the stock market, right? You said it. It's the earnings of individual companies should start to actually factor in, which is kind of silly to say. It should always matter, but it should seem moving forward that will be a bigger driving component of what does the market actually do? How is it reacting to the outside influence, where hopefully we get back to actual, relying on fundamental data and not just necessarily emotional headline driving news.
Yeah, and all the more important not to just chase what seemed to work the quarter before. If you kind of came into the year and went, oh, gee, I didn't really own growth, so now I'll own more growth. I'm just looking at like 401k statements where it shows you like the last quarter, the last year. If you just always end up chasing the thing that was best, the last quarter, man, you're going to be zigzagging all over the place. I think it's even more important now to recognize yes, returns have gotten into a really great spot after what felt like mayhem last year. Be diversified, stick to the fundamental asset allocation. Yes, you probably own some international that's only got 2/3 of the rate of return of, the equity markets here in the United States.
Mm-hmm.
But you still need to hold that, because over time, there's going to come a time where the valuation's there and the returns there are going to be better than here. So you have to do it.
Yeah. So on that front, I did some looking at numbers there too. And a lot of the commentary we're, again, hearing, seeing, reading is that, right, the US as a whole is kind of leading the charge out of the bottom here, right? We're in the, maybe not necessarily the first, but we are leading when it comes to vaccinations and just reopening the economy. There are still many pockets of Europe, especially in Asia, that are not quite at anywhere near the vaccination levels that we are. So the thought being, right, the US has outperformed pretty much any global market that you can pinpoint. And that's a big reason. But now moving forward, if we start to plateau, right, because we've kind of hit maybe critical mass when it comes to the vaccine rollout, other countries still have room to reopen, ramp up, that should bode well for more global investments. We'll see if that actually comes to fruition. But that's, like you said, that's the reason why we don't necessarily want to try to be super tactical to get out of the US and now we're going to move to international. No, same reason we didn't just get out of international and just move all the money to the US. We believe in diversification. That's why you don't put all your eggs in one basket. So hopefully over time you are rewarded for owning a little bit of everything.
Yeah, and I guess if there's one key takeaway from this, that's it. And we would have come into the podcast saying that, we're going to leave the podcast saying that, all these things are going to happen. Headlines are going to happen. We're going to look back on returns and say, woulda, coulda, shoulda, and at the same time, be very happy for what has happened. But it's not to change how you approach things moving forward. Stay diversified. I think volatility will pick up and almost has to. Again, just because pendulum swings to it's been too quiet for too long, there'll be some panic button pushed on something, and hopefully it's not a big deal. But expect it and stick to the financial plan. That's really where asset allocation needs to be sourced from. Certainly when it comes to people we advise.
Yep. So people are going to stop tuning in and listening to us at this point because they're going to say, well, they never say anything. They just say, stick to your plan.
That's right. That's right.
We could just start every podcast episode with that.
And they don't sign on to look at our faces. I know that. So. No, but I hope that when there are these key headline things, that it still becomes a reoccurring theme of, confidence can be built by saying, yes, we paid attention. Does this need to change our plan? It is a conscious decision. It's always a conscious decision not to do something massively different, and be able to talk about the time when it does need to change. So as it pertains to 2021, nothing big yet. Yet. All right. Anything you want to add?
No, sir.
All right. Appreciate your time. Let's hope the second half of the year is much of the same.
I agree. Thank you.
Catch soon. Thanks, Adam.
Bye. See ya.
Hey everyone, Adam and I really appreciate you tuning in. Please note that the opinions we voiced in the show are for general information only and are not intended to provide specific recommendations for any individual. To determine which strategies or investments may be most appropriate for you, consult with your attorney, your accountant, and financial advisor or tax advisor prior to making any decisions or investing. Thanks for listening.